In this video, guys, I want to share with you a momentum trading tactic to jump on the first kind of counter trend move after a momentum ignition drive. Sounds complicated, but stick around. Hey guys, warm welcome to you. All right, so very often we have this scenario, right? We have a scenario where we have a big move in the underlying market, and we want to kind of try to time a pullback to get short or to get long. Okay, we want to kind of really leverage on the fact the market's moved in a big direction very quickly and wait for it to kind of do its first pullback and rotation, and then try to time that for a subsequent retest of highs or lows. There's lots of gaps in this cues, but this was the type of thing I'm talking about. Big drive lower, pulls back. How do we time that, especially intraday, for a revisit of lows? How do we time this drive, big drive higher? How do we time this pullback here for a revisit of highs? How do we know how far that's going to go? So I've got a little tool for you that I've done another video about it for an intraday perspective, but it's actually it's a kind of community tool that is available on TradingView, but you can code your own, you can put it in by hand. It's basically looking at the expected range of the trading day, and it's a daily ATR tool. And the only reason I put it on this now is I would normally draw the lines by hand and manually. But what this is basically saying is, okay, what's the expected range of the trading day? And I've put in here the parameters: 1 day ATR, 10 period, 0.5 to 1. So in other words, that's given me half the expected range, and that's given me 1. So this area here is effectively where I'd expect it to reverse. Go and check out the deeper video. We're going to kind of a lot more information about this, but you can do this by hand. You don't need this tool, you don't need TradingView. All this is basically saying is, what's the ATR? If the ATR is 100, it's basically saying, or whatever the sum may be, let's say it's $10. It goes, right, okay, well, if it's $10, I'm going to put this at $5, this at $5, this at $10, this at $10. That's basically what it's saying. In other words, if it went from high to low, that would be your kind of normal ATR. If it went from open right to the end, that would be 1 ATR. You get the idea. So, right, fine. That's from a day trading perspective. An intraday perspective. What about when we're looking for these big moves? How do we time the reversal on this? So the way to kind of do this, and by the way, guys, no guarantees, no assurances or anything like that. This is just really for you to look at and go and explore by yourself and see, hey, is this something I want to use to help make trading decisions or not? That's simply the only way this can be done. So let's example here. We'll look at both of these because they're both kind of big drives that you want to trade back in the direction of momentum type play. You see the momentum. We'll talk another time about how to jump on that momentum or ways to try to identify it before it happens. But if you aren't on the momentum, next best thing is to wait for the spring to kind of contract again and then look to jump on for a move. But the issue we have is we don't know how far it's going to go, right? It's very difficult to judge. So let's have a look at this. 15th of June. Okay, so we've had this dig down move from the 8th. So let's expand this. We've had this big, there it is. We've had a big down move from the 8th. Bang, bang, bang. Gap lower. And now we kind of want to try to judge where we want to get short again. A good way of doing it is the first time after we've had these persistent down moves, 1, 2, 3, 4, the first time it touches that high zone, in other words, the half an ATR to 1 ATR is where we look to position short and we look to cover on a retest of lows. It worked well in this scenario, and if you go back and look at the drive high we had on the 25th of May, again, this is kind of these extreme moves. It only works in kind of a big extreme mood. So a big 3-day go. Okay, I missed it. Whatever. I need to get on it somehow. How far is this going to go back? And again, you don't know, right? This one popped right back because the open was higher and went here. Now, if you're using an ETF, this is why it's so powerful, because the ETF will plot this, or the tool will plot this, or you should plot this based on the open. So the open is the print, half an ATR higher, half an ATR lower, 1 ATR higher, 1 ATR lower. There's your frame of reference. Now you've got a frame of reference to get short on. To get long on. We've had the drive up, we want to get long. We don't want to overstay our welcome, but we want to try and find a sweet spot to get long. Now, let's look. 27th of May was the last point we had the drive. Okay, so we've got 27th of May, closing at highs. Right, now we want to look for the first test of this shaded area, which is the half ATR from the open, half to 1 ATR. Almost got it here. No, pulls back. And there you have it. It starts to hold, and we get a revisit of highs. Even though the rest of the chart looks scrappy, the first kind of retracement back to expected levels of downside gets bought, and we get a push back to highs. Similar as we did to the downside. The kind of extension back up to the expected range of the high side, got sold, we go back to lows. So it's something to consider. Now, of course, you have to have a stop structure in place. You have to try to look for some kind of reversal pattern. That's when your trigger candlesticks come in, whether you're using some kind of engulfing, whether you're using some kind of double bottom, some kind of wick, whatever it may be. The trigger candlesticks are the nuance and are less important than this filtering process, which is persistency of trend, 3-4 days to the high side or downside, looking then, framing those ATRs, looking for the reversal intraday, finding a trigger candle to get on, obviously using a stop and managing risk, and then exiting the trade, quick pulse back to highs or back to lows. I think it's something it's worth exploring, guys. Check it out. The guy who wrote this is freely available, by the way, in TradingView. The guy who did this is, I don't know him, Ty Funix. But you don't need this. This is a very simple piece of code, and he's basically just done it for you. But you can quite easily do this by finding out the ATR in a 10 period, during a horizontal line, there, or box every day. And the good thing is, you don't have to look at this every day. You just go, hey, persistency of trend. Right, now I'm going to draw my boxes each day afterwards, and then you're ready to initiate the trade. Potentially, if it's matches all your risk criteria when it gets into that zone, and then you kind of know it's a very, very easily structured trade. All right, guys, hope that's helped. See you next one. Keep the risk managed. Take care. Bye bye.